are not a finished article. I think there's a great possibility for the company to be truly globally competitive. We have a strong, steady balance sheet. Team is now a lot more global. Hierarchy is flat. People feel comfortable to interact and to disagree. And I feel that there's an important culture that we need to allow us to navigate the choppy water so that we continue to hear different perspectives and allow us to walk with a lot greater confidence as we continue to journey ahead as we pursue growth. Hi, morning everyone, shareholders. So nice to be having this AGM in a physical setting. I think the last time the old CapitaLand had a physical AGM was in 2019 when we sought shareholders' approval for the merger between CapitaLand and Ascendas Singbridge, which actually laid the foundation for the subsequent restructuring to privatize the development business and subsequently also to list CLI, which all of you today are shareholders of. Thank you for all the support. I believe it has allowed the shareholders to unlock shareholder value, at least in the short run, but more importantly, to create the platform, which is a CLI platform, that will allow us to continue to build new capabilities and to grow enterprise value along the way. Today, CLI has 4 key earnings drivers, which is largely the REITs business, which I'm sure all of you are very familiar with. We have 6 listed REITs, 5 of them in Singapore. I think the key for the REITs team is to make sure that we can continue to grow the various REITs under our care and also to look at possibility of creating new REITs. For the lodging management, led by Kevin, the business, when it first started out, used to be very asset heavy. In terms of ROE, it was always perceived to be a drag. But since about 10 years ago, we started to go asset light, essentially building up a whole portfolio of properties around the world, signing management contracts for owners. And today, you look at the numbers that the team has demonstrated, apart from during COVID, when the numbers were, of course, badly affected because there were travel restrictions. You see the lodging business being a key driver in terms of fee income for the business. And the last part, which is the private equity funds business, the CapitaLand actually started out this business maybe 10 years ago, but more to help us in our development business. The private equity fund business that we are building today, it's really to focus very much on raising third-party capital from institutional investors, from pension funds, from including high net worth retail investors to give us the necessary capital to look at new acquisitions, and which is why we have engaged people like Simon Tracy and Patrick to join us to help us to push ahead on this part of the business. So we actually have very big ambition for CLI as a company. Internally, we want to position CLI as to be amongst the very best in the world, to compete with the most established asset managers globally. But that's going to take time. It's going to take time. We can't imagine that we can perform magic overnight. But what's going to happen in the next few years, the next 5 to 7 years, we really want to focus our energy in Asia Pacific, which is our backyard, where we have built up a strong reputation. Many of the people in the property sector knows us well. The banks are very comfortable with us. People who want to do deals, they will look for us because they know that we have the ability to close deals. And the banks also, the banks will also be very, very comfortable to continue to lend us, even in very difficult climate. So that's essentially what our ambition will be and our priorities over the next few years. We hope that for Asia Pacific, what will success look like? will be that for any major investors that want to invest in real assets in Asia Pacific, we must be amongst the top asset manager that comes to mind to many of these investors looking for investment opportunities. But the road ahead, while we are clear in terms of what we want to achieve, the road ahead, we believe, will be a lot more uncertain. There will be a lot more bumps. Compared to the last 2 decades, we have a very benign macro environment where interest rates were going down, and generally the geopolitical environment was a lot more favorable. You look at the year 2022, just last year, we started the year full of confidence, and before long, we were confronted with Russia-Ukraine conflict. And then you have all the different central banks around the world, led by the US, raising interest rates very aggressively to deal with a very persistent inflation around the world. And of course, the other challenge that we had to deal with was COVID-19, especially in China, where as a country, they continue to have rolling lockdown. And the greatest impact was in Shanghai, where there was a total lockdown for about 60 days. And the impact was real. The retail, our shopping malls could not function, people could not go into offices. That's the business impact. And of course, as a company, we have to help the tenants along and continue to have to give rental rebates to make sure that we could journey together to overcome the difficulty during the COVID lockdowns in China. And naturally, that had affected our business performance in the year 2022. But I also want to take the chance to share some insights about the teams in China. During the periods, especially in Shanghai, the 60-day lockdown, we had many people that continued to stay in the offices, in the shopping malls, in the business parks. They couldn't go home. Some of them, when the lockdown happened, it happened so suddenly, they didn't even have time to go home and pack their clothes. They stayed there, lived in makeshift beds, and some of them, because, we have retail tenants that have, they have to continue to water the plants, and for some that have certain animals in the malls that we have, they have to feed the animals as well. So it's a really trying period for our colleagues in China, and I just want to give you some snippets of the actual realities of not just from Singapore. When you just read the news about the COVID lockdown, it's just one side of the story, but managing the actual conditions on the ground is actually complicated and quite complex. So really appreciating my team in China for all the hard work. Actually, towards the end of last year, I must say that when we were preparing the budget for this year, at least I was quite pessimistic, because I was just not sure when China was going to lift the COVID restrictions. But towards the end of last year, after the 20th Party Congress, they make the firm decision, decided to lift the COVID restrictions, and the business activity has recovered very, very significantly. And this year I've been to China a number of times, including Chairman Miguel. He was in Shanghai, Suzhou, and Hangzhou last week. You see people, the typical thing, you go to China, you see traffic, the traffic jam is back. The restaurants are full. You have to have you have to sit there and queue to get into the restaurants. So to me, I'm generally quite optimistic about the recovery of the Chinese economy, and given our presence in China, I think that will continue to help us to drive the income growth, help us to look for new opportunities, and continue to help us in the capital recycling in China. So that's in terms of the outlook for China. In terms of the future, as you saw in the video earlier, I believe, as a company, CLI is well positioned for growth for three key reasons. First and foremost, it's the reputation that we have built up in Asia. For every market that we operate in, if you have a chance to travel, you see the malls, you see the offices, you see the service apartments, you see the business parks, it's operating. When we decide to start a project, we always finish it, and we have never, ever let any of our partners, including the banks, down. And that is very, very important in terms of reputation that will continue to help us to pursue growth. The second would be our balance sheet. Balance sheet today, if you look at our gearing, it's very, very healthy. A lot of access to facilities, including the cash on our own balance sheet to look for growth. Continue to help us to support our various vehicles, whether it is for the REITs to pursue accretive acquisitions or to help seed new funds. And more importantly, the balance sheet that we have to allow us to look for counter-cyclical investment opportunities, which we believe should be emerging more over the course of the next 12 to 18 months. Like last year in Beijing, we took the chance to use our balance sheet to buy an office asset. It was a court auction process. People were concerned. What we did is that we managed to take the chance to buy an asset below 30, which is about 30 to 40% below valuation. And actually the completed building itself, with the land and the building, is actually cheaper than the cost of land. And that's the kind of opportunity that we are prepared to take because of the teams on the ground and the balance sheet that we have. And the third, I would say one of the most important issue, it is the quality of the people that we have built up. The team is a lot more global, a lot more diverse, and more importantly, we are building up a culture where people are free to speak up, to challenge, to bring different perspectives. And the reason why this is important is the investment that we are looking for is a lot more global across different asset classes. The deals that we look at are a lot more complex. If we do not build up a culture that people are willing to speak up, to challenge, you will find that you missed out on certain perspectives, and when you make investment decisions, there will be cases where you actually make mistakes, and which is not what we want to do. And the fundamental premise of how we are building up the business is we are not going to pursue growth at all costs, not pursuing growth for growth's sake, but to make sure that we can continue to deliver consistent, sustainable earnings for our LPs in the private funds, for the unit holders in the REITs, and for the investors at CLI. So with this, I just thought useful for me to introduce my senior leadership team, to invite them to come on board, for you to get to know them, to the team that I'm talking about, and for the few key people that's going to be responsible in helping us to pursue growth and to deliver the outcomes for all the different shareholders. Andrew and team, please. Thank you. Andrew, you want to start off?
Thanks, Chee Koon, and good morning to everyone. Thank you for joining us. Again, it's a pleasure to be in person presenting our results for 2022. I'll spend a couple of minutes explaining the COO's role. The group COO's role, or Chief Operating Officer, is a role that we haven't had at CapitaLand for a while. So I've had some questions from our stakeholders asking me what exactly it is that I do. So I'll do my best to explain. As Chee Koon mentioned, as part of the restructuring, we reorganized CapitaLand Investment to comprise principally 4 fee income streams. And my heads of our product partners are standing here on my left. So that part, I think, should be clear. Chee Koon explained this earlier. The purpose of these 4 key products is to drive fee income, which is essential to our operating model going forward. Now, what underpins these 4 products, and on this slide that you see before you is what I like to call the house that we are building for CLI. Underneath these 4 principal products, we have the countries that work in tandem with each of these products. As you may know, we have 3 core markets. These are Singapore, China, and India. We have 3 focus markets, Japan, South Korea, and Australia. Together, they comprise the bulk of our business in Asia Pacific. Roughly 85% of our capital is at work today in Asia Pacific. And of course, for good diversification and for strategic reasons, we maintain a material presence in Europe and North America. These are very deep, very liquid real estate markets that our REITs and hopefully one day our private equity funds and of course lodging products are already invested into. So my role as COO is, together with all of our respective country heads in all of these countries, to work hand in hand with our 4 principal product partners in order to ensure that we deliver sustainable fee income growth that is resilient, that is recurring, that's predictable, and obviously gets us to 100 billion of FUM in 2024 and beyond as we chart the course ahead in what is an increasingly uncertain environment. And obviously, under that, we've got our centralized functions that are supporting all of us. So I hope that it clarifies the role of the Chief Operating Officer. My role is to look after the countries. I'm happy to take any further questions or clarifications that you may have. John?
Thank you, Andrew. Good morning, fellow shareholders and ladies and gentlemen. As Chee Koon mentioned, we have 6 REITs within the CapitaLand family, 3 of which, as you see on the leftmost screen, invest in developed or global markets in the chosen sector of commercial, new economy, and lodging. And at the same time, we have 3 REITs invest in emerging markets, as seen on the rightmost screen, in the markets of China, India, and Malaysia. Because they are, in a way, country-focused, they invest across sectors. So through these sector proxies, as well as country proxies, we offer our listed fund investors choice to invest in what they best match their risk-return profile. In managing these 6 REITs, we take a disciplined approach. And as even before the current interest rate environment, we already take an approach to have as much of as our interest costs locked in as realistically possible. So across the 6 REITs, it's no coincidence that you see 71 to 81% of the debt are already locked in on a fixed rate basis. And the same discipline also extends to the way we approach investments. In looking at new investments, we take into consideration the immediate as well as long-term returns, as well as the way we're going to fund it and the cost in funding it. So increasingly, you see that other than raising fresh debt and equity, we also undertake portfolio reconstitution to reinvest by unlocking the value by selling assets which are at relatively good prices and recycle the capital to invest in new investments. And other than making sure that we grow through new investments, we also grow through asset enhancements and sometimes redevelopment. As you can see across the screen, these are some of the examples that we have undertaken in terms of asset enhancements over the last 12 months. And sometimes we also do redevelopment, such as a Capital Spring. And we are in Raffles City right now. We just undergone the AEI last year. And if you have not visited it, please take a walk after the AGM to look at the new mall. And I guess other than through all these enhancements, we also look at the revenue and expenses to make sure we manage them well. And with that, I'm going to end my quick update by just to thank all our investors, tenants, as well as occupiers of our portfolio, and thank you for your support. I'll now hand over to Simon.
Great. Thank you very much, John, and good morning to everybody. My name is Simon Tracy. I'm the CEO for Private Equity Real Estate. I joined CapitaLand back in the restructuring in 2021. Private equity is a clear strategic focus and growth area for the company, and we're very focused on the Asia-Pacific region. The target sectors that we're investing in include office, retail, industrial, and multifamily or rental housing. The beauty of our platform is that we have a combination of different types of funds by sector, by country and also regionally. These country funds we have are in China, India, South Korea, and Japan. China is a key market for us, and we've been very successful launching a number of RMB funds, and we'll continue that strategic initiative over this year and hope to make new announcements. At the same time, we see opportunities in that changing market to make opportunistic investments in China, as well as the other markets around the region. The funds that we invest in are both a combination of low risk, low return with steady yield, as well as higher risk, higher return investments such as value add, where an investor can achieve a stronger risk-adjusted return. It's these value add strategies that we will continue to pursue during this year. I just want to give you a quick little mini case study on a very recent acquisition that we announced last month in Japan, where we've been operating for 20 years. It's an acquisition undertaken by our Core Plus regional fund. It's a transaction where we committed to acquire at completion 6 multifamily or rental housing properties in Osaka. Over 400 units, the average size is about 450 feet. And if you were renting there, you would pay about 1,300 Singapore dollars per month. So this is an example of a strong market which we like, where we have strong capabilities and track record in that local market. Thank you.
Thanks, Simon. Good morning, everyone, and thank you for your time today. I'm Patrick Bucock. I'm CEO of Private Equity Alternative Assets, essentially any asset sector that sits outside of the traditional real estate sector. Today, I'm going to touch on 3 of our key priorities. The first one being private real estate credit. What we've been seeing recently with the market volatility, we've been seeing base rates increasing, spreads widening, and commercial banks slowing down the pace of their lending. This bodes extremely well for non-bank lenders. We've taken the time over the last year to execute on a strategy, building up our team across APAC. Our immediate focus is Australia, where we see great borrowers with great assets that are looking for credit products that are just off the fairway of where the commercial banks are lending. We see substantial opportunity to be lending in that space. Investors increasingly are looking to private credit as an alternative asset class, given the strong downside protection. And again, in a volatile world, it's something that they have high interest and conviction in. The second strategy I want to talk about is our data center strategy. As the economist pointed out, the world's most valuable resource is no longer oil, it's data. Secular trends of AI, autonomous driving, 5G, cloud computing, e-commerce, etc., will continue to push the demand for digitalization significantly. APAC is the fastest growing market in the world in terms of data center development and consumption, and China is the second largest market outside of the US. With that, we want to leverage in our incredibly strong DC platform, which today has 26 assets, 500 megawatts, $6 billion of AUM, leverage that and leverage the team that we have, an integrated team that focuses on design, development, and operations, and client relationships to start to build additional scale. As you can see from the screen behind us, we recently announced a China data center fund focused on two data centers in Greater Beijing at 100 megawatts, which on a fully completed basis will deliver $1 billion of FUM. We're also building capabilities and identifying assets in other parts of Asia to continue our growth story. The third alternative asset class that I wanted to mention is self-storage. We see tremendous secular tailwinds in this sector across APAC. In addition to the traditional 3Ds being divorce, dislocation, displacement, and we're seeing other things in APAC that present additional opportunities, including increased urbanization, higher proportion of renters, and a continued growth in e-commerce. As you can see in the slide screen, you'll see that we recently announced a self-storage transaction, initial commitment of $570 million, which can potentially be increased to over $1 billion. And we see continued growth in that sector. Thank you for your time. Over to Kevin.
Good morning, shareholders and fellow colleagues. My name is Kevin. I take care of the lodging vertical. Just to recap, it is a very fee-focused, asset-like business. I'm happy to share that we have achieved our 160,000 target, something that we set for ourselves about 5 years ago, right, when we were at 80,000. So 5 years on, we're at 160,000. 2022 is a story of recovery for the lodging business. Throughout the year, we see different countries open up in different points in time, and we see revenue recovering. Across the span of the full year, we've seen RevPAR, which is revenue per available room, increased about 40%. In terms of growth, the reason why we have managed to hit our 160,000 target ahead of time is really because our organic engine is still growing very strongly. We added about 15,000 keys last year, despite all the COVID constraints that we face. And we also bought a company called Oakwood that brings along another 15,000 keys. So last year, we added over 30,000 keys to our network. If we go on to the next 5 years, we have been reflecting quite a bit on this and said, what should our next 5-year targets be like? And we are now putting a lot of focus in generating fee income. Right? Last year was a record year for us, 258 million of fee revenue. You might be wondering, because we've been suffering the impacts of COVID throughout the whole of last year, how did we do a record 258 million in revenue? That's really because the teams have been working very hard in opening new properties. So as you have more SKUs and more operating properties, the fee income come in, although on the same store basis, we have been affected by the COVID situation. So in the next 5 years, we're really going to invest a lot more on our brands, our people, our systems. We're going to target to double the current record of 258 million to over 500 million in fee revenue. And this is done through more new openings, more aggressive openings, and quality signings that give us high fee and faster time to market. Right? So hopefully 5 years from now, we'll be standing in front of you and say that we have overachieved what we set for ourselves. Now, just to round off, the lodging business really is a very resilient, very sticky cash flow business that's built on long-term management and franchise contracts. And the foundation of all this is really the strong brand loyalty and recognition that we enjoy today. So we'll continue to build on that. We'll continue to add value to all our stakeholders, whether you are our owners, our customers, our shareholders, and also the community that we operate in. So hopefully that gives you a good idea and a summary of the lodging business in 2022 and how we see ourselves going forward. Thank you.
Thank you. Thank you, Kevin, and the rest of the senior leadership team. I hand the time back to Grace for the rest of the AGM proceedings. Thank you for your listening to us. Thank you.